We see Nigeria, Africa's largest economy, is at a pivotal moment in its economic journey as the country grapples with various challenges ranging from global economic uncertainties to internal structural inefficiencies. There's a growing need to reflect on recent developments and project the path forward. Joining me for this now is Naira, who's a macro strategist at AfriInvest. Compliments of the season.
Good afternoon, Ladi. Glad to be on this show on this very last day.
Always great to have you. And yeah, we had the last trading day today. We had Willie Bond give us a sense of how it was right there with the energy on the trading floor. So for you, they say the stock market is the barometer of the economy, of any economy at this point. And we've seen the all-share index do really well in 2024. So, talk to me about the economy in 2024 and what we've seen play out in Nigeria's stock market.
Well, so let me start by saying that shall I say, the belief that the stock market is a barometer to assess the economic health is not really something that is cast in stone because largely the Nigerian market performance has detached from the economic reality. And I'll give an example. Even in 2020, when there was COVID pandemic and the economy contracted by about 1.93%, the Nigerian stock market returned 50% that year to emerge as perhaps the best performing stock globally, according to Bloomberg. And if you look at the trajectory of the market since 2020, it has not dropped the ball. It has continued to gain. But when you then look at other macroeconomic variables, the dynamic is a bit different. Now, moving to the question you asked properly, as per what were the things that shaped 2024, honestly, there were a lot of moving parts in 2024 that shaped the economic outcome, as I will put it, for Nigeria this year. You want to look at it from a broader perspective of external versus internal variables or drivers. On the external side, at the end of 2023, there were high optimism that inflation momentum in advanced economy, we begin to weaken from Q3, and that maybe there will be multiple rate cuts, which will help incentivize capital flow to emerging markets. But that didn't come through in Q1, neither did it come through in Q2. It was until Q3 that we began to see rate cuts in advanced country because inflation in that region too was a bit sticky. And the negative effect of that is the amount of capital flow that emerging markets were able to attract, even with high rate, was not as substantial as it should be. Yes, for instance, Nigeria is on course to posting its largest FPI flows, I think, since 2019 or so. As of 9 months, we have done more than $6 billion, so which means we are likely to surpass the level we had in the last 4 or 5 years. But we are still not going to be hitting that 2019 level where we have FPI's attraction of about 23.9 billion. So meaning that the delay in inflation moderation in advanced countries affected us a bit. Plus the fact that there were escalation of geopolitical tension. Late 2023, there was an attack on Israel, and that was the beginning of a crisis that has spanned more than a year. That affected supply chain, that affected prices of energy goods, and the ripple effects told on the local market as well. Now, when you then look back domestically, what are those major factors that shaped the year? Honestly, you want to look at how we have performed from the budget, because that's the biggest fiscal variable you want to consider. From the budget side, the NTF data shows that revenue challenge remains. Debt service outshoots the pro rata level. We have about, I think, budgeted 8 trillion debt service to do this year at a pro rata of 8 months of about 5 trillion. But we have done 7 trillion debt servicing as of that time. But when you then look at capital expenditure, we budgeted about 9 trillion expenditure around capital. Pro rata for the 8 months should have been around 6 trillion. But we have only been able to do slightly above 3 trillion. So meaning that the capital component of our budget, which should have catalyzed the economy, we have only done about 1/3, if I put it that way. So by and large, it's been a challenging year, especially on the fiscal side. And the effect of that is, the jacking up of our debt profile, going from 97 trillion to 134 trillion as of H1. If you estimate the recent Eurobond and other debt number that the government has secured, we might be heading towards around 140 trillion. But that does not mean there are also no upside development this year that are, encouraging. The breakthrough in having a refinery in Nigeria for several years is a thing to cherish. Yes, it could be argued that the refinery we are having, the one we first had, is a private one. But of course, the government also supported that initiative to succeed. And again, we are also hearing news of the state-owned refineries in both Port Harcourt and Warri coming upstream. So these are some of the positive highlights. But by and large, it depends on the side of the divide you belong to. But for most citizens, honestly, the effect of exchange rates, inflation, which some of it are ripple effect of legacy challenges as well as imported inflation. Most citizens will tell you that 2024 was very tough because inflation is a very terrible thief of value.
Right.
And when people are not able to value exponentially.
Okay, Larry, let me come in here. So, you did mention the refineries, and the latest one, coming online is the Warri refinery. So, seeing all these refineries, springing up, and definitely we have the private sector-led Dangote refinery. Is this telling us we're going to have energy security going into 2025?
Well, we still have to contextualize it, right? If you look at the entire production capacity of the state-owned refinery in Nigeria, even plus the Kaduna, the two in Delta, the two in Port Harcourt and one in Delta, even if we have all the 4 state refineries producing at their peak, their outputs still cannot meet local need up to 35 or 40% based on consumption numbers that we have seen over the years. We have had time where we're told average consumption about 35 million barrels per day. So, but it's a good thing we are having it. Now, where we will have had respite is the Dangote, because the Dangote refinery, if it's able to produce or deliver output at its optimum capacity, it will not only fully meet local demand, but it will also have sufficient export to other African countries. So by and large, if there's a coordination, because the situation Nigeria is finding itself around energy, we are not even at risk of energy unavailability, except we deliberately inflict that on ourselves. So if there's a coordination between the government and the private sector that now own a refinery, and there are so many modular refineries that are coming upstream. So if there's that coordination and everybody is allowed to play fairly in the market, there's no deliberate hindrance to whether the private or the government-owned one, we shouldn't have problem of energy availability. But that is a different subject when you then talk about price, because what most people want to hear is that would there be a significant fall in price of PMS? The reality is that PMS is a global commodity priced in dollars. And when you look at what has happened to our exchange rate, where it has lost more than 80% from about 481 to over 1,005 in the space of 19 months, it will be very difficult to expect in a fair market level to expect PMS falling below 800 level. But the reality is that if there is no deliberate hindrance in terms of coordination, we shouldn't have problem of scarcity again. And I think that's one menace we don't want to experience again. Last year, we had scarcity episode about 3, 4, 5 times. This year, we had it like 2 times. So we now have local refinery that can guarantee us supply. So that's the good news I think we currently have for now. But as regards price, we are still going to deal with energy price around this level because of FX exchange rate dynamics.
Yes, I guess what would be good news to many consumers now is to see those PMS prices actually come down, maybe sub 500 or something. That would definitely be great. But talking about high prices, inflation, we've seen food inflation definitely did get as high as 40%. It moderated, below that 40% level. But now it's technically almost back there at 39.93%, looking at food inflation numbers for November. So, and this is a period where people would love to eat a lot, and we've seen prices high at the market. So going into the first quarter of 2025, what are you seeing for food inflation, food prices?
I think barring any major shock, a combination of high base effects, stabilization of FX rate, because you agree with me that over the last 1 month or so, there have been significant stability in the FX market. In fact, there have been pockets of mild gains, especially since the CBN introduced the EMFS platform, which has helped enhance transparency. And there are other reforms we can talk about that the CBN has rolled out in 2023 that is at least supporting improved FX flow through the official channel. So by and large, if you put high base effect on one side, added to that a sort of stability in the FX market, we think that by the time we're moving towards the end of Q1, inflation should have moderated slightly, even if it is to around 30% level. I mean the headline rate. Now, same as food inflation, by the time we are moving to, because if FX prices stabilized, I mean, it will have effect on PMS. The reason why some of the price of PMS has come down a bit, Dangote selling at about 800 plus, NNPC2 at around that level. The reason why we are having that is because FX stabilized and perhaps there are some mild gains. If FX rates should go up significantly, the prices of these people will go up and it will have effect on the market because energy is a commodity that binds everybody together. So by and large, barring any shock, high base effect, FX stability should support at least a modest decline in inflation, headline and food inflation, headline to about 30% and food to about 36% by the end of Q1. And if the government can also then roll out a lot of, other policies that will support local productivity, that will support local manufacturers, such that their cost per unit will not go up, but rather it will moderate, then we can begin to think of at least a medium-term positive outlook on inflation. So that's our view for that. But barring any shock, we should see inflation moderate towards Q1 2025.
Right, and I guess another key metric that manufacturers would be looking at is interest rates. Going into 2025, what are you seeing right now for most developed economies? They've cut rates in 2024, but from the U.S. Fed, there are indications that in 2025 there won't be 4 rate cuts as expected. That's been cut to 2, and we also see projections that the central bank MPC here might start cutting rates in 2025. How are you seeing all of that play out?
We don't see the CBN cutting any rate until maybe H2. We don't see a rate cut in Q1 2025. I think the best we can see, the MPC is expected to commence its bi-monthly meeting in January. So we don't see them cutting rates in January, neither do we see them cutting in March. If there will be any early cut at all, perhaps maybe in May, and because of the delicate situation of Nigeria, you talk of inflation currently at 34.6% level, that's the headline, food at almost 40%. The only reason why anybody will expect inflation to at least moderate in Q1 is because of high base and because of relative stability in FX, not because our production level has increased significantly. And when you look at the law of demand and supply, so long demand, continues to outweigh supply, there will be element of inflation. So by and large, yes, we believe there is a room for CBN to cut rate, but not until mid-year, because by that time, there will have been what I would call a lot of attraction towards emerging market from advanced countries, because by that time, we expect that at least the advanced market, the US, UK will have done one more rate cut, which will have meant that asset pricing in those places are not as attractive as it should be in emerging market. Then that should then incentivize capital flow to emerging markets. And the increase in FX flow towards this part of the world, whether in terms of foreign portfolio investor or investment or foreign direct investment, should then help reduce FX pressure and also expand productivity. Because as FX pressure is reducing, people can even still borrow. Manufacturers are actually facing two headaches. If they are borrowing a number in Naira, they are paying interest rates of 30% and above. If they are to import using dollar, they are putting down too much of Naira to get a unit of dollar. They need to put down 1,000, 1,000. So it's a double whammy. So if one of the pressure points is moderated, at least, or moderates a bit, let's say the FX, then this guy can be able to produce at a relatively reduced average cost, and this will have effect on exchange rate and inflation. But this is not something that can play out within a week or a month. So that's why we feel that even if there will be any room for rate cuts, on the basis that advanced economy would still do at least one more rate cut in H1, then there won't be any negative trigger locally to drive prices of commodities like energy up again sharp. Then we might begin to see respite, because by the time we are moving towards H1, all things being equal based on our budget projection, headline inflation should have been moderating towards 27% level. And at that point, the CBN might have the incentive to say, oh, let's reduce the MPR a bit, even if it's by 25 or 30 basis points, to begin to signal long-term rate cuts. But even if there will be any rate cuts in 2025, cumulatively in the base case, it won't even exceed 150 basis points. That is the level of delicate Nigeria economy is playing with in 2025. But we believe we can get it right, and we can have a positive 2025 performance in all sectors.
Right, and it's quite incredible. We've done about 850 basis points rate hikes. That's in 2024, and hopefully it gets lower, going into 2025. But you did mention FX, and some would say the Naira weakening is a major cause of the problems we've seen so far with PMS prices, with inflation, and imports at this time. So our foreign reserves now, that stands at about a bit over $40 billion right now. At what point do you think we should start looking at pegging the Naira at a particular rate that works for everybody at this point, and what kind of reserve we should have to actually make that happen? Because we've had all the arguments about pegging the Naira and all of that, and not having enough to defend it. So what do you see going forward? At what point do we peg?
I think that's a very interesting question. But if you look at the policy objective of this administration, as well as the body language of this current CBN governor, I'm not sure Nigeria want to consider pegging the exchange rates anytime soon because of the effect. Now, you talk about the current level of our foreign reserve, about 40 billion or so. That's gross reserve. Nobody as of today, maybe except the CBN governor, is very clear on what the net reserve level is. And the implication of that is the ability of the CBN to supply the market adequately. We did a study last year, which we captured in our banking sector report. And what we saw is that on average, in the years between 2007 and 2014, CBN supply to the market in terms of FX supply is in the 40 billion level region. Post that time, there was never any time annual CBN supply, intervention, injection, whatever you want to call it, into the market. There was never any time after 2014 that injection reached 30 billion. What that means is that there has been constrained supply. Now, this is happening at a time where FX value, exchange rate is depleting, and also population and demand is growing. You will have expect that for an economy like Nigeria that is still not very self-sufficient, that we import a lot, injections should still be very healthy up to that. Towards the level we used to have when we have stable exchanges. So because we don't have clarity on what the net FX reserve is, and also because of the fact that the CBN currently have also not been able to anchor inflation the way it wanted it. So I think it will be very risky. And if you look at some of the inflows to the reserve this year, they are from what I would call inorganic sources. The CBN have rolled out a lot of OMO bills this year at very attractive rates. The last OMO auction under the last CBN governor was priced at about 11%. The last OMO auction in Nigeria per 365 days was priced in the region of 23-24%, meaning that it's a cost. It's not cheap dollar. Also, we are getting dollar from bilateral loan, World Bank approval, Eurobond. The last Eurobond, the 6.5, the 10-year was priced at about 8 point something and 9 point something. Those are not cheap dollar. The sort of cheap dollar that could have given the CBN the confidence that, we're pegging the FX rate at 1,003, and we'll ensure adequate supply to back up that sort of pricing, will have come from if we're able to ramp up our oil production. I have argued with people that if Nigeria is able to ramp up its crude oil production to above 2.1, 2.2% level, especially at a time like this where we now have local refineries, from net inflows from crude oil alone can overshoot 30 billion, which would then mean we have strong reserve. Not to talk of what you then expect from remittance, what you then expect from foreign portfolio investment. But because we have not even strengthened the organic sources, because the organic sources are inflows that come without any price. If we sell crude oil and we earn money, it is net inflow. Nobody's going to take that from us. Nobody's going to buy it. Some of the dollar loan we acquire or we have gotten, they are project tied. Yes, we hear the numbers, but the money can only be used for specific purpose. And until the need for that purpose arises, in terms of maybe there are plannings on ground, the CBN cannot use it. So that's why I said the net position of the reserve will give a clearer picture of whether the CBN can say, oh, we want to peg the FX. But what we think the CBN is doing, which we think they will continue to do into 2025, is to continue to intervene in market to temper aggressive demand-supply imbalance. And as long as they do it, and the fiscal side too corroborate by helping to remove some of the bottlenecks that are affecting the organic sources, then things will be better. If we can ramp up crude oil production, and also we can support the manufacturing sector to be exporting, we can revive our tourism sector. There are a lot of countries that are living on tourism. Countries like Saudi Arabia are making a lot from tourism. Countries like even Kenya in Africa. So these are the organic sources that whatever comes in as FX inflow will be net for us, and nothing will take it away. But until we do this, the CBN will not have that war chest to be able to peg the Naira at a certain level. In fact, it will be devastating. The long-term consequence will be worse than what we experienced in the last 19 months if they do so now without our organic FX sources coming to life.
All right, definitely. So much to unpack there. Tomorrow will be, all of us will all be in 2025, and we'll see how it plays out. And with the right policies, we can make all our dreams a reality for this economy. Thank you so much. That was Damilare Ashimi, who's the macro strategist at AfriInvest. Thank you for coming on today, and compliments of the season.
Wishing you the same, laddie. Thank you.